Everybody, Adam Schmela, Certified Financial Planner with Integrated Planning and Wealth Management. I wanted to do a quick video for you here today to talk about not only some perspective around what's happening in the capital markets, but also some very real and practical action items that you can think about doing here given what we're experiencing in the market. So let's first pause, let's take a deep breath, let's think about some things, and more importantly, let's put some perspective on this. So when we think about the market, a lot of times what you'll see and what you'll experience if you're watching TV or reading the paper or on social media, on your phones, whatever that may be, is you will hear things referred to as the market being the S&P 500 or the Dow Jones Industrial Average or the NASDAQ or the Hang Seng or whatever index they're talking about. But if you're an investor that has a well-diversified and well-allocated portfolio, I want to caution you on comparing your portfolio and the decisions that you make with your portfolio to whatever index that you may have seen news on or heard talked about on the news. So a metaphor that I'm fond of talking to people about is comparing a well-diversified, globally allocated portfolio to the S&P 500 is like comparing the health of the entire produce department at your local grocery store to how the Honeycrisp apples are looking right now. So if the Honeycrisp apples are not in season, not doing very well, bad frost, whatever would cause Honeycrisp apples to not be doing so well, does that mean that the entire produce department in the rest of the store is that we should throw it all out as well? Well, of course not. So we want to make sure that we're not being so myopic in our entire portfolio just based off of something that we saw in one specific portfolio. That's not to say that we don't discount it and that we just throw it away and don't worry about it, but I want to make sure that we're not jumping to conclusions on decisions that you make with your entire portfolio. Now, having said that, indices give us some type of comparative benchmark to use when looking at the overall health of, quote unquote, the market, whichever market that is that we're talking about. And popping up on the screen right here is a graph provided to us by First Trust Portfolios. And this graph shows, from a perspective standpoint, what the bull and bear markets have looked like in the S&P 500 going back from 1926 until basically the end of September 2018. Now, what you'll notice about this is that there's a lot of blue on this graph, right? The average bull market lasted 9.1 years with an average cumulative return of 480%. Now, had someone invested back in 1926 and literally did not make a single decision and rode every single wave, the average bear market that they would have experienced during that time lasted 1.4 years with an average cumulative loss of 41%. Again, the idea of investing is that we are gaining return in exchange for a certain amount of risk that we're taking. We don't know, I don't know, you don't know. Any investor over the grand scheme of things in the long term does not know when and how long bear market corrections, volatility, whatever term we want to put around a decline in the market, we don't know when or how long it's going to last. But from a historical perspective, we do know that investors, if looking at just the S&P 500, have been served very, very well, even with the risk involved in some corrections during that time. And so what that means is that during those periods of decline, there are opportunities to think about, and there are action items that you can take. Again, from an investor's perspective, and more importantly, I guess maybe even just from a human perspective, we like to fix things, right? When things are uncomfortable, when things are going wrong in our mind, we want to try and fix things. And so what I want to do is share 3 ideas that you can take to implement or at least evaluate implementing in your portfolio here. And it's what we're looking at here as well with clients and things like that as well. Again, every person's situation is unique. And if you do have questions about anything that I'm talking about here today, make sure that you seek a qualified expert, talk to your advisor, talk to your tax advisor, your CFP, those types of individuals to help you make the right decision. But first of all, these types of opportunities, and I say that very seriously, these opportunities give us the opportunity to reallocate and rebalance our portfolio. So what is the fundamental rule of investing, right? It's buying low and selling high. That's how we make money in investing from a pure capital appreciation standpoint. And so when markets are going ups, downs, and sideways like this, looking at your portfolio, if it's a well-diversified portfolio, looking for rebalancing options where you can sell off what has done good and buy what has underperformed or in a decline right now can give you that mix of investments that's well suited for your investment tolerance, risk capacity, and time horizon. Another thing to look at taking advantage of is tax loss harvesting. This can help from a tax perspective, being able to offset some of your gains that you have in other assets and other asset classes this year. And even if you were to harvest losses to the extent that it exceeds your gains, you may be able to even offset some of your taxable income here. Again, this is something where if you have questions about this, make sure that you consult your tax advisor and your investment advisor to make sure that you're aware of the 30-day wash sale rule, things like that. We don't want to get in trouble with the powers that be when it comes to tax loss harvesting. And last but not least, if you're in a position where the money that you're looking at on the sidelines, if you're looking to put that to work, again, exercising the fundamental rule of investing when we buy low and sell high. If you have a long-term time horizon and you have that opportunity to deploy capital, now might be the time to think about doing that. Investing and buying stocks and buying investments is the one thing that psychologically we kind of run in the opposite direction of what we would normally do in any other area of life. Right? If I tell you that Amazon is having a flash sale, or Kohl's or Macy's or Nordstrom's, or pick retailer of your choice, if they're having a flash sale and what you would have bought yesterday at full price just went on sale by 10%, and you can buy the exact same thing, the product is still good, the fundamentals of the product are still strong, but it just went on sale by 10%, most people would jump on top of that. Investing is the one thing that we kind of are wired a little bit to think about differently. And so just look at maybe this being an opportunity to buy things on sale that you otherwise maybe would have bought in the beginning of August or the beginning of September, whenever markets were at their highs. So I hope these give you some actionable items. I appreciate you watching. Hope you have a great rest of the day.